Hi. Let's learn about EBITDAR. Earnings before interest, taxes, depreciation, amortization, and restructuring or rent costs, or EBITDAR, is a non-GAAP tool used to measure a company's financial performance. It does not appear on a company's income statement, but it can be calculated using information from the income statement. EBITDAR can be calculated in several different ways. The most common way is to add restructuring and/or rental costs to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. The earnings portion of EBITDAR calculation refers to net income, which is the all-inclusive, non-restrictive earnings that a company has made in a given period that is not yet adjusted for any items below. Interest expense is the cost incurred for securing a debt or line of credit with an outstanding balance. Companies may choose to eliminate this cost because it may not be controllable by management. Tax expense is the cost imposed on a company for local, state, or federal taxes. Companies often do not have a say in their tax assessment, so it may be removed for internal analysis. Depreciation is the allocated cost of a tangible asset over its useful life. Companies may have much control over how depreciation impacts their net income calculation. Amortization is the spreading of costs over the useful life of an intangible asset. It is a non-cash, uncontrollable expense that management may not care to analyze. EBITDAR eliminates restructuring costs and rental costs to focus only on costs that are related to operations. This helps to reduce variability from one company's expenses to the next when comparing peer companies within the same industry. EBITDAR is a metric used to analyze the financial health and performance of companies that have gone through restructuring or have unique rent costs. It exists alongside earnings before interest and tax and earnings before interest, tax, depreciation, and amortization, EBITDA. For example, company XYZ earning $1 million in revenue and incurring $400,000 in total operating expenses, including depreciation, amortization, and rent, among other costs. After calculated net income and EBIT, company XYZ further backs out additional costs to arrive at EBITDA, and then rain corporate rental costs to arrive at EBITDAR. The difference between EBITDA and EBITDAR is that the latter excludes restructuring or rent costs. Both metrics are utilized to compare the financial performance of two companies without considering their taxes or non-cash expenses such as depreciation and amortization. The difference between EBITDAR and EBIT is more substantial. EBIT includes restructuring and rental costs, which EBITDAR excludes. EBIT also includes the costs allocated to a good over its useful life. Net income includes all company-wide expenses, whether they require cash outlay or not. It does not distinguish between different types of costs. EBITDAR removes certain costs to allow for easier financial performance analysis without the variable impacts net income. EBITDAR is calculated by subtracting interest, taxes, depreciation, amortization, and restructuring/rent costs from earnings. A company can calculate EBITDAR by manipulating either EBIT or EBITDA. Instead of using EBITDA, EBITDAR is used by companies that recently underwent restructuring. It is also used by casinos, restaurants, or other businesses that typically pay rent for better analysis of financial performance. The difference between EBIT, EBITDA, and EBITDAR is the amount of items that are taken out of earnings for analysis purposes. EBITDAR has more items adjusted out than EBITDA and EBIT. Here are 5 key takeaways. 1. EBITDAR is a profitability measure that adjusts net income to be internally analyzed by removing certain costs. 2. It's better for casinos, restaurants, and other companies that have non-recurring or highly variable rent or restructuring costs as these expenses are taken out of net income. 3. EBITDAR gives analysts a view of a company's core operational performance apart from expenses unrelated to operations, such as taxes, rent, restructuring costs, and non-cash expenses. 4. Using EBITDAR allows for easier comparison of one firm to another by minimizing unique variables that don't relate directly to operations. 5. EBITDAR may unjustly remove controllable costs which may not hold management accountable for some costs incurred. Hope this would help. Thanks for watching.